$100 billion disappeared from the American banking system. The losses were not caused by war. They were not caused by a market crash. They came from banks that had been allowed to gamble with insured deposits. In the 1980s, thousands of savings and loan institutions were suddenly free to take bigger risks. Deregulation promised growth. Politicians defended it. High returns attracted deposits. Behind the expansion was reckless lending, insider abuse, and accounting manipulation. Executives enriched themselves, losses were hidden, and the risks were transferred to taxpayers. When the structure finally collapsed, the public paid the bill. This was not just bad banking, it became one of the largest government-enabled banking scams in American history. This was the savings and loan crisis. Before the crisis, savings and loan institutions served a narrow purpose within the American financial system. They were designed primarily to support home ownership. Most of their assets consisted of long-term residential mortgages. Their funding came from local deposits collected from local communities. The model was simple. Depositors placed savings into local institutions. Those funds were then used to finance home loans. This structure linked community savings directly to housing construction. For decades, the model appeared stable. After World War II, the United States experienced a massive housing expansion. Millions of new homes were built across expanding suburbs. Savings and loan institutions became the primary lenders behind this growth. By the 1950s and 1960s, thousands of these institutions operated across the country. Their activities were tightly regulated. Interest rates on deposits were capped. Investment activities were restricted. Most loans had to be traditional fixed-rate mortgages. The system emphasized stability over profit. Regulators wanted predictable lending rather than aggressive financial innovation. Depositors also received federal protection. The Federal Savings and Loan Insurance Corporation insured deposits against failure. This insurance reassured households that their savings were safe. For decades, the model functioned with few disruptions. Mortgage payments arrived slowly but reliably. Local depositors continued adding funds to the system. As long as interest rates remained stable, the structure remained viable. But the structure contained a hidden vulnerability. Most mortgages issued by savings and loans were fixed for 30 years. The interest rate on those loans rarely changed. Deposits, however, could move much more quickly. When depositors demanded higher returns, institutions had limited flexibility. For many years, this mismatch did not create immediate problems. Inflation remained relatively moderate through the early post-war period. Interest rates changed slowly. The mortgage portfolios continued generating steady income. But the system depended on one critical assumption: stable interest rates. If rates changed dramatically, the structure would come under pressure. The institutions held long-term assets that could not easily adjust, yet their funding depended on depositors who could withdraw money at any time. For decades, this imbalance remained mostly invisible. The industry appeared conservative and stable. Thousands of small lenders quietly financed suburban expansion. By the late 1970s, however, the financial environment began to change. Interest rates started moving in ways the original system had never been designed to handle. The foundation of the savings and loan model was about to face its first major structural test. By the late 1970s, the financial environment surrounding savings and loan institutions began to change rapidly. The United States entered a period of sustained inflation. Consumer prices rose throughout the decade. Inflation pushed interest rates steadily higher. For savings and loan institutions, this shift created a structural problem. Most of their assets consisted of long-term fixed-rate mortgages. Many of these loans had been issued years earlier at relatively low interest rates. Typical mortgage yields were often between 5 and 7%. At the time they were issued, those returns were considered normal. But inflation changed the financial landscape. By the end of the 1970s, market interest rates had climbed far beyond those levels. Short-term interest rates began rising into double digits. Depositors quickly noticed the difference. Other financial products now offered much higher returns. Money market funds and new financial instruments started attracting deposits. Savings and loan institutions could not easily match those rates. Regulations limited the interest they could pay on deposits. As a result, depositors began moving their money elsewhere. This process became known as disintermediation. Deposits flowed out of traditional savings and loan institutions, yet their mortgage portfolios remained locked in to older, low-yield loans. Income from mortgages remained fixed. Funding costs began rising. This created a widening financial gap. Institutions were earning low returns on long-term loans, but they were being forced to compete for deposits in a high-rate environment. Many savings and loan institutions were suddenly losing money. The longer interest rates stayed high, the worse the imbalance became. By the late 1970s, hundreds of institutions were technically insolvent. Their assets were worth less than their liabilities, but most of these losses were not immediately recognized. Accounting rules allowed institutions to continue operating. Regulators feared that closing large numbers of lenders could destabilize the housing market. Instead, many institutions were allowed to continue operating despite deep financial weakness. The system had entered a dangerous phase. Savings and loan institutions were no longer simply conservative mortgage lenders. They were financially trapped organizations. Their survival depended on finding ways to generate higher returns. This pressure would soon reshape the entire industry. The crisis had not yet become visible to the public, but the economic foundation supporting the system had already begun to crack. The structure that had financed decades of American home ownership was now under severe stress, and policymakers were about to search for a solution. By 1980, policymakers believed the savings and loan industry required structural change to survive. Many institutions were already struggling under the pressure of rising interest rates. Regulators feared widespread failures across the mortgage lending system. Instead of allowing institutions to collapse, lawmakers pursued deregulation. The goal was to give savings and loan institutions new ways to earn profits. In 1980, Congress passed the Depository Institutions Deregulation and Monetary Control Act. The law began removing interest rate limits on deposits. Savings institutions could now compete more aggressively for funding. But the legislation also expanded the financial powers of these institutions. Savings and loans were gradually allowed to invest beyond traditional mortgages. This change altered the foundation of the industry. For decades, their role had been narrow and predictable. They accepted deposits and issued home loans. Deregulation opened the door to a broader range of financial activities. 2 years later, Congress passed another major reform. The Garn-St. Germain Depository Institutions Act of 1982 further expanded these powers. Savings and loan institutions gained authority to make commercial real estate loans. They could invest in land development projects. They could participate in riskier forms of lending. The intention was to help institutions recover from their earlier financial stress. If they could earn higher returns, they might rebuild their balance sheets. But this new flexibility introduced a powerful incentive. Many institutions were already technically insolvent. Their existing assets were worth less than their liabilities. In that situation, conservative lending offered little chance of recovery. High-risk investments, however, created a different possibility. If risky projects succeeded, the institution could recover its losses. If those projects failed, deposit insurance would absorb the damage. This created a classic moral hazard. Executives could take larger risks with insured deposits. Profits would remain private. Losses could eventually be transferred to the insurance system. At first, the shift appeared to offer relief. Deposits began returning to some institutions. New lending opportunities expanded rapidly. But the industry had entered unfamiliar territory. Savings and loan institutions were no longer conservative mortgage lenders. They were becoming speculative financial intermediaries. The regulatory gate had opened, and the incentives inside the system were beginning to change. By the early 1980s, the savings and loan industry had entered a new phase of expansion. Deregulation had opened the door to activities that had previously been restricted. Institutions were no longer limited to traditional home mortgages. They could now pursue higher-yield investments across multiple sectors. Many executives quickly embraced these new opportunities. Commercial real estate became one of the most attractive targets. Office towers, shopping centers, and hotel developments offered higher potential returns than residential mortgages. Large development projects began appearing across the United States. Savings and loan institutions financed many of them. Land speculation also expanded rapidly. Institutions began funding projects based on projected future property values. In some cases, construction loans were issued before projects had secured stable tenants. The pace of lending accelerated throughout the industry. Assets at many institutions began growing at unusually fast rates. Annual asset growth of 30% or more was not uncommon. Regulators had limited experience supervising these types of investments. Many institutions lacked internal expertise in commercial real estate lending, yet the pressure to generate higher returns remained constant. Some institutions also began investing in high-yield corporate bonds. These instruments offered attractive interest payments, but they carried significantly higher default risk. The shift in lending behavior reflected a deeper structural change. Savings and loan institutions were no longer primarily housing lenders. They were becoming speculative investment institutions. Competition between institutions intensified the process. Executives feared losing deposits if their institutions appeared less profitable than competitors. Rapid expansion became a signal of success. New branches opened, large projects were financed, balance sheets grew quickly, but growth often concealed rising vulnerability. Many projects depended on optimistic assumptions about future property prices. If real estate markets slowed, these loans could quickly deteriorate. By the mid-1980s, the industry looked larger and more profitable than ever before, but much of that growth rested on increasingly fragile foundations. Risk had expanded faster than oversight, and the financial system supporting these institutions was becoming increasingly unstable. By the mid-1980s, many savings and loan institutions were already financially unstable. Losses from earlier interest rate shocks had weakened their balance sheets. Risky lending had increased their exposure to volatile markets. Yet the full scale of these losses was not immediately visible. Accounting practices allowed institutions to delay recognizing financial damage. Regulators introduced policies that became known as regulatory forbearance. Instead of forcing insolvent institutions to close, regulators allowed them to continue operating. The goal was to avoid triggering panic across the financial system. If hundreds of institutions failed at once, depositors might begin withdrawing funds from others. Forbearance gave troubled institutions additional time, but time alone could not repair deeply damaged balance sheets. Accounting rules began to play a critical role. Some institutions were allowed to record assets at values far above their true market price. This practice created what critics later called phantom capital. On paper, institutions appeared solvent. In reality, many were already deeply insolvent. Losses were effectively hidden within accounting structures. Executives could report positive financial statements even while underlying assets deteriorated. This environment created powerful incentives. If losses were not immediately recognized, institutions could continue expanding. Growth could temporarily mask financial weakness. New loans generated new accounting income. Balance sheets appeared larger and healthier, but much of this stability existed only within financial reports. Outside those reports, loan portfolios were becoming increasingly fragile. Commercial real estate markets began showing signs of oversupply. Large development projects struggled to attract tenants. Land values stopped rising as quickly as they had earlier in the decade. Some projects began defaulting on their loans. When those loans failed, institutions faced large losses. Yet accounting structures allowed many institutions to postpone recognizing them. The longer this continued, the larger the hidden losses became. Financial statements no longer reflected the true condition of the industry. Observers inside the regulatory system began warning about growing instability. But the combination of deregulation and accounting flexibility delayed decisive intervention. By the late 1980s, the gap between reported capital and actual financial health had widened dramatically. Many institutions appeared healthy on paper, but beneath those reports, insolvency was spreading across the system. The illusion of stability was becoming increasingly difficult to maintain. By the mid-1980s, a more dangerous pattern began to emerge within parts of the savings and loan industry. Some institutions were no longer simply taking aggressive financial risks, they were engaging in direct insider abuse. Executives controlled lending decisions with limited oversight. In some cases, those executives began directing loans toward projects they personally controlled. This practice became known as self-dealing. Loans were issued to companies owned by executives, partners, or close associates. The transactions often appeared legitimate on paper, but the projects frequently lacked viable business foundations. Some developments existed primarily to move money out of the institution. Funds from insured deposits were redirected into speculative ventures. Real estate developments were particularly vulnerable to this behavior. Land was purchased at inflated prices. Construction loans were issued to related companies. The same properties were sometimes resold multiple times between connected entities. Each transaction increased the apparent value of the asset, but the underlying economic value often remained far lower. These transactions inflated balance sheets. Loan portfolios appeared larger and more profitable. In reality, many of these assets were becoming increasingly unstable. Regulators struggled to monitor the rapid growth of these activities. Thousands of institutions were expanding their lending operations at the same time. Supervisory agencies lacked sufficient staff and resources. Complex loan structures made oversight even more difficult. Some executives realized that enforcement remained inconsistent. This created additional incentives to expand risky or fraudulent activities. If projects succeeded, executives could earn substantial personal gains. If projects failed, the institution and ultimately the insurance system absorbed the losses. The structure of incentives encouraged increasingly aggressive behavior. Certain institutions grew extremely quickly under this model. Asset growth sometimes exceeded 50% per year. Rapid expansion became a signal of success within the industry. But behind the expansion, loan quality continued to deteriorate. Many projects depended entirely on rising real estate prices. When those prices slowed or declined, the weaknesses became visible. By the late 1980s, regulators were discovering widespread insider abuse across multiple institutions. Investigations began revealing patterns of self-dealing and fraudulent lending. The savings and loan crisis was no longer only a problem of deregulation. Fraud had now become embedded within parts of the system. By the mid-1980s, warning signs inside the savings and loan industry had become increasingly visible. Regulators began raising concerns about risky lending practices. Investigators were documenting cases of insider abuse and speculative real estate financing. Yet meaningful enforcement often moved slowly. The industry had developed strong political connections. Savings and loan institutions operated across nearly every American state. They were closely tied to local housing markets and regional economies. As financial problems began appearing, executives and industry groups turned to political lobbying. They argued that aggressive regulation could worsen the crisis. According to this view, troubled institutions simply needed time to recover. Lobbyists warned that closing institutions too quickly might destabilize housing markets. Some members of Congress accepted these arguments. Pressure began building on regulatory agencies to proceed cautiously. In several cases, regulators attempting to tighten oversight encountered political resistance. The most famous example involved a group later known as the Keating Five. Charles Keating was the head of Lincoln Savings and Loan in California. His institution had grown rapidly through high-risk investments. Regulators within the Federal Home Loan Bank Board began investigating Lincoln Savings. They were concerned about the scale of its speculative investments. Keating responded by contacting several United States senators. 5 senators later met with regulators to question the investigation. The meeting raised concerns about political pressure on the oversight process. Although the senators denied wrongdoing, the episode became a national controversy. It illustrated how political influence could affect financial supervision. For regulators already facing limited resources, these pressures complicated enforcement. Some investigations slowed. Other institutions continued operating despite serious warning signs. Meanwhile, risky lending practices continued spreading across the industry. Developers still received large loans for speculative projects. Real estate markets in several regions became increasingly overheated. Behind the scenes, the financial condition of many institutions continued deteriorating. The combination of deregulation, weak oversight, and political protection created a fragile environment. Executives understood that regulatory action often moved slowly. This allowed risky strategies to continue longer than they otherwise might have. By the late 1980s, the structural weaknesses of the system were becoming impossible to ignore. Failures began appearing across the country. What had once been a contained financial problem was turning into a national crisis. Political protection had delayed intervention, but it could not prevent the eventual collapse of the system. By the mid to late 1980s, the weaknesses inside the savings and loan system were no longer hidden. Real estate markets in several regions began to slow. Property values stopped rising at the pace institutions had expected. Many development projects could no longer generate the income required to repay their loans. Commercial buildings remained partially empty. Land speculation projects stalled. Developers began defaulting on large construction loans. When those loans failed, the losses quickly appeared on institutional balance sheets. For years, accounting practices had delayed recognition of these problems, but the volume of failures was now too large to conceal. Savings and loan institutions began collapsing across multiple states. Some institutions were seized by regulators. Others were closed after exhausting their available capital. Depositors remained protected through federal insurance, but the insurance system itself was under severe strain. The Federal Savings and Loan Insurance Corporation had never been designed to absorb losses on this scale. Hundreds of institutions were now financially insolvent. In Texas, California, Arizona, and several other states, failures accelerated rapidly. Real estate downturns intensified the crisis. Projects financed during the speculative boom were now worth far less than their original valuations. Banks attempted to sell seized properties, but oversupply pushed prices even lower. This created a downward spiral. More institutions recorded losses. More institutions failed. Between 1986 and 1989, the number of failed savings and loan institutions increased dramatically. Regulators struggled to manage the growing wave of collapses. Each failure required transferring insured deposits to healthier institutions or government management. The financial burden on the insurance fund continued expanding. Public awareness of the crisis began increasing. News reports documented widespread failures. Investigations revealed insider abuse and speculative lending practices. Confidence in the industry deteriorated. The savings and loan system that had once financed suburban homeownership was now collapsing under its own structural weaknesses. What began as a regulatory experiment had evolved into a full financial breakdown. By the late 1980s, the scale of the savings and loan crisis had become undeniable. Hundreds of institutions had already failed. Many others were deeply insolvent but still operating. The deposit insurance system that protected customers was now under severe pressure. The Federal Savings and Loan Insurance Corporation no longer had the resources to manage the growing losses. Each institutional failure required transferring insured deposits to another institution or government control. The costs continued rising. By the end of the decade, policymakers concluded that the existing system could not contain the crisis. In 1989, the United States government introduced a major restructuring plan. Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act.
The law fundamentally reorganized the regulatory structure of the industry. One of its central components was the creation of a new agency, the Resolution Trust Corporation. The purpose of the Resolution Trust Corporation was to manage and liquidate failed savings and loan institutions. Instead of leaving insolvent institutions operating indefinitely, they would now be systematically closed. The RTC assumed control of hundreds of failed institutions. It inherited massive portfolios of troubled assets. These included unfinished real estate developments, commercial property loans, and land speculation projects. Many of these assets had little immediate market value. The government began selling these properties through auctions and asset liquidation programs. Large volumes of distressed real estate entered the market. This process took several years. Between 1989 and the mid-1990s, the RTC resolved hundreds of failed institutions. The financial cost to the public was substantial. Estimates placed the total bailout between $100 and $130 billion. Taxpayers ultimately absorbed most of these losses. The funds were used to protect insured depositors and stabilize the financial system. The crisis represented one of the largest financial rescues in American history at the time. It also demonstrated the cost of allowing financial risks to accumulate within insured institutions. For decades, savings and loan institutions had operated within a relatively stable framework. But once incentives shifted towards risk-taking, the consequences spread quickly across the system. The bailout closed a painful chapter for the industry, yet the deeper questions about regulation and incentives remained. The savings and loan crisis had revealed how fragile financial systems could become when oversight weakened, and the cost of repairing that damage would ultimately fall on the public. By the late 1980s and early 1990s, the collapse of the savings and loan system had triggered widespread investigations. Regulators and federal prosecutors began examining the causes of the crisis. Many cases involved reckless lending. Some involved deliberate fraud. Investigations uncovered patterns of insider abuse, self-dealing, and accounting manipulation. In response, federal authorities launched one of the largest financial crime investigations in American history. Special task forces were established to examine failed institutions. Thousands of cases were reviewed by investigators. The objective was to determine whether executives had violated banking laws. Prosecutors focused on institutions where evidence of fraud was strongest. Several high-profile cases quickly attracted national attention. One of the most prominent involved Lincoln Savings and Loan. The institution had been controlled by financier Charles Keating. Investigators determined that Lincoln Savings had pursued extremely risky investment strategies. Customer deposits had been used to support speculative ventures. Many of these investments later collapsed. Eventually, regulators seized the institution. Criminal charges followed. Charles Keating was later convicted on multiple counts related to fraud and racketeering. Other executives across the industry also faced prosecution. Hundreds of bankers were charged with criminal offenses. Many received prison sentences. Others were banned from participating in the banking industry. Regulators also strengthened enforcement mechanisms. Financial institutions now faced stricter reporting requirements. Supervisory agencies received expanded authority to intervene earlier in failing institutions. These legal consequences represented an attempt to restore public confidence. The crisis had severely damaged trust in financial oversight. Investigations revealed how weak supervision and aggressive incentives had encouraged abuse. By the early 1990s, the most intense phase of prosecutions had concluded. Hundreds of criminal convictions had been secured. Yet the deeper causes of the crisis remained subjects of ongoing debate. Some analysts focused on deregulation. Others pointed to the role of deposit insurance in encouraging excessive risk-taking. In practice, the crisis reflected a combination of these forces. Legal accountability addressed individual misconduct, but the structural lessons extended far beyond individual cases. The savings and loan crisis had exposed how fragile financial systems could become when incentives and oversight diverged. By the early 1990s, the immediate phase of the savings and loan crisis had largely ended. Hundreds of institutions had been closed or restructured. Regulatory reforms had been implemented across the financial system. Yet the deeper lessons of the crisis extended beyond the institutions that failed. The crisis revealed a pattern that appears repeatedly in financial history. It begins with a stable financial structure. Institutions operate under predictable rules. Risk-taking remains limited. Over time, economic pressures begin to challenge that stability. In the case of the savings and loan industry, inflation and rising interest rates created the initial stress. Policymakers then attempt to solve the problem through structural change. Deregulation becomes the chosen solution. New financial freedoms are introduced. The intention is to allow institutions to recover through growth and innovation. But those same freedoms can alter incentives inside the system. When institutions are already financially weak, new risk-taking opportunities create a dangerous dynamic. Executives may pursue aggressive strategies to recover losses. If the strategy succeeds, the institution survives. If the strategy fails, losses expand rapidly. Deposit insurance changes the risk calculation. Depositors remain protected even if institutions fail. This removes an important layer of market discipline. At the same time, political influence can slow regulatory intervention. Institutions may continue operating even after becoming insolvent. Losses accumulate quietly inside the system. By the time failures begin, the financial damage is already extensive. Public intervention becomes unavoidable. The government must protect depositors and stabilize the financial system. The cost of that intervention falls on taxpayers. Private gains during the expansion phase are not matched by private responsibility during the collapse. The savings and loan crisis demonstrated this imbalance clearly. Financial deregulation was intended to rescue struggling institutions. Instead, it expanded risk-taking inside insured organizations. When the system finally collapsed, the public absorbed the losses. This pattern has appeared in multiple financial crises before and after the 1980s. When profits are private and losses are public, incentives distort reality.